Carnival Cruise Corporation was absolutely devastated during the pandemic. The business found ways to survive, and now it's thriving, and its cash flow and its profits are soaring higher than ever. But what's a fair price to pay for Carnival Cruise stock? That's the question I'm going to answer in this video, doing a discounted cash flow valuation on Carnival Cruise stock. So let's get into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So what I have here is the discounted cash flow model for Carnival Cruise stock. And what you'll notice is that the analysts on Wall Street that are following Carnival, they expect its free cash flow to absolutely soar over the next decade. In fact, between 2024 and 2029, the Wall Street analysts that are following Carnival stock, they expect its free cash flow will grow from 1.3 billion all the way up to 4.85 billion in 2029, a roughly 4x increase in that amount of time. Now, that increase is fueled by several factors. Number one being that consumers are unleashing this pent-up demand for away from home experiences. Remember, cruise lines were closed for the better part of 2 years during the pandemic. And so people missed out, and they want to make up for that by going on cruises to make up for lost time. Also, Carnival Cruise is charging significantly higher prices than they were in 2019. So that's also fueling this increase in free cash flow. And there's also another opportunity for Carnival Cruise that may or may not already be incorporated into this free cash flow forecast. And I'll address that a little bit later when I start to talk about its capital structure. So these analysts from 2024 and 2029 expect its free cash flow to grow meaningfully. I actually expect its free cash flow to continue growing between 2029 and 2034. And I forecasted that Carnival Cruise's cash flow will grow by a 15% compound annual rate in those years. And then starting in 2035, I expect the company's free cash flow growth to settle down and reach its equilibrium growth rate of around 5%. I expect its free cash flow long-term to grow at about 5% at the rate of growth of developed economies worldwide. And demographics work in Carnival Cruise favor. The population of the world is aging, and people that are older tend to have more time for travel. And that's great news for Carnival because that means that's a bigger customer base it can attract into its cruise ships. So if we take the present value of all of those free cash flows for Carnival Cruise Corporation, they total $27 billion. Also, if I look at its free cash flow from 2035 to infinity, I can take the terminal value of those cash flows, which brings together all of those free cash flows expected between 2035 and infinity. It brings it all to one point in time, here in 2034, at $128 billion. And then from this point, you take the present value of this cash flow and what it's worth today. And that value is $37 billion. And so the value of operations for Carnival Cruise is $64.86 billion. That takes the present value of all of those future cash flows. Now, the discount rate I applied for Carnival is 13%. I gave them a higher than usual cost of debt because most of the debt that Carnival Cruise has came during the pandemic when it was in a desperate situation. But typically when you're evaluating a weighted average cost of capital for a corporation, you want to look at the incremental cost of debt. How much would it cost for the company to borrow today, not how much it cost for the company to borrow 3 years ago, which for Carnival works in its favor because 3 years ago, it was paying a much higher rate to borrow money. Remember, if you're a lender and you're looking at Carnival and its business is almost completely shut down, and it's burning through billions of dollars of cash every day, and it's asking you to borrow money, are you going to give it good terms to borrow money? At that point, you didn't know when or if Carnival Cruise was going to start operating again. And so lenders charged Carnival a very high price for debt. I don't expect that to be the same going forward. I expect Carnival, which has over $30 billion of debt right now, I expect it will be able to refinance that debt at lower interest rates. I also expect Carnival to utilize some of this free cash flow that it's generating to pay down its debt, which is what management has talked about doing over these next few years. I see that as an opportunity for Carnival stock investors. Also, the capital asset pricing model cost of equity for Carnival came out to 20%. That also is higher than what I would expect for the company going forward. So I see that as an opportunity as well. Right now, it has a beta of 2.67 because this is the beta of the company going back 5 years. And included in that is the pandemic period when its stock price was highly volatile, when its business was shut down. I expect its beta for the next 5 years to be lower than 2.67, significantly lower than 2.67. Right? So the weighted average cost of capital I have at 13%, I see that as going lower over the next 5 years. The company has a market cap of 33 billion and total debt of 30 billion, but I give them a target capital structure of 75% debt and 25% equity. Target meaning over the next 5 years, I expect their debt to decrease as a percentage of its total market cap. I expect that trend to continue for several years. Before the pandemic, Carnival's total debt was around $10 billion. So I expect the company to use this free cash flow it's generating over these next 10 years or so, or maybe even more, to slowly pay down that debt. Because the only reason they needed to borrow that money was because of that once in a lifetime event, or hopefully once in a lifetime event of the pandemic. So the value of operations at 64.8 billion, non-operating assets of 1.5 billion, minus debt of 30 billion brings us to a value of equity of 36 billion for Carnival. If we divide that by the number of shares outstanding at 1.4 billion, we get a market price of we get an intrinsic value per share of $25.81, which is very close to the current market price of $25.68. So on the surface, this looks like a fairly valued business, just looking at the surface of these calculations. But if you dig a little deeper, I think there's opportunity for this stock to become undervalued as it makes those capital structure changes going forward, as it pays down some of that debt, as the business becomes more stable and the beta decreases. Those two forces will combine to lower its weighted average cost of capital and therefore increase the present value of all of these free cash flows and thereby make the stock undervalued in the future. So this is something that is potentially going to become undervalued if they can continue generating these levels of cash flows. But for now, the business is fairly valued according to these numbers and these estimates. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.